are broadcasting live only on onedealaway.com/live. My name is Nev. This is Money Matters, and the setup is a little bit different because Nev is having some technical difficulties. I apologize for that, but the show must go on, as they say, even if it is a little bit late. So, what are we going to talk about today? Well, today in today's episode, we're going to be discussing quite a bit about the new SEC rules for finder fees, crowdfunding, and that kind of stuff. We're also going to be taking a look into the market, and we're going to be talking about what happened with the DeFi protocol Harvest Finance, where they lost $24 million of individual funds. We're going to be looking at what the banks are actually doing and what's going on over there, as well as what professional investors are doing with their money and how they plan on investigating and getting into the whole thing. As you can see, we have quite a bit of a show, and let's do this. All right. Well, we'll keep it at least one thing the same in the transition, right? So, again, my apologies. This is pretty much the screen that I could figure out how to work this morning. So, it's always a fun morning. You never know what the technology is going to do, right? Oh no, no, no. Let's not do that. Let's go. Let's go incognito. It's already weirdo, so let's just go incognito with the weirdo. So let's talk about what's going on with the SEC stuff. So this particular article focuses a lot on the real estate syndication. However, a lot of this stuff can also be translated into other crowdfunding ventures that exist. And one of those ventures could be potentially if you are launching a new product and you're looking for crowdfunding to kind of help you with it. But of course, we do see a lot of that in syndication in real estate. So that's what this is really focusing about. And they're talking about how, over the recent months, they're actually taking a U turn when it comes to the crowdfunding, and it's now being highly supported by the SEC. When a company syndicates a deal, they're not selling real estate. They're actually selling shares in a company that owns that real estate, typically an LLC, and as such, they're selling securities. Well, when they sell securities, that means that SEC gets involved, and that means that they get to make the rules. So that's basically what is going on. Now, the way that the SEC defines crowdfunding, regulates crowdfunding, and regulates the various industries that can benefit from crowdfunding, including real estate industry, can have dramatic impact on how capital is acquired and used. And of course, they have done a few different things. For one, they can actually increase the sponsor limit. Now, the sponsor is the person that puts the deal together and goes out there and basically raises the funds to go out and invest. And what they have done is in March of 2020, the SEC decided to increase the limit the sponsor can raise from $1 million to $5 million. That's a 5x increase in what you can do. And of course, that is using the regulation crowdfunding, or CF. Reg CF is the section of the 2012 Jobs Act that allows sponsors to raise money via funding portals like Small Change, for example, or other portals that I'm sure you heard of, like Kickstarter, I want to say, or something like that, from accredited and non-accredited investors alike. This is an important piece right over here: accredited and non-accredited investors, because there's also a lot of things that are being regulated that you can do a lot of things with accredited investors that you can't with non-accredited investors, and that is very important for us as we are looking to raise funds, but also for investors who are saying, like, I really want to participate in some of these things. And the government kind of makes it, they break it down to say, well, you're not accredited, as such, you are broke or stupid or whatever, you can't participate in this deal. Meanwhile, those deals tend to be, more often than not, some of the most profitable and the safest deals out there. They just tend to be also very illiquid. Now they're not guaranteed, right? So it's not like a savings account. And part of the challenge with, I get it with the government and stuff, as we'll see today in the episodes, as we kind of go through different articles and conversations. It's also people to blame. On one hand, they're saying, I'm an adult, let me play, let me do my thing. But the moment something doesn't go their way, they go home crying to mommy and be like, Jimmy hit me. And so then mommy goes out there, right? So you got to decide. You're either a big boy or you're not, right? You are neither an adult to take full responsibility or you're not. But people want everything, right? They want the freedom to go out there and invest like all of the wealthy people, but they also want, when something goes wrong, to go back and then have the big bad government step in and beat everybody up and give them their money back. Well, you can't have it both. And so it's not easy for the government and regulation, because now they are stuck. And I'll show you some of the example of what's been going on in the world with that kind of stuff. So when you say, no, Nev, that doesn't happen, yes, Nev, it does happen, and it happens quite a bit. And personally, I just think it's absolutely ridiculous that is what's going on. So if you don't want to play, don't play. But when you go out there, play, and you lose, well, don't be going crying to anybody. You lost because you didn't pay attention to what you needed to do. Anyways, let me know how you feel about the whole thing. P.S. By the way, talking about you, I do want to welcome everybody watching this live on onedealaway.com. Please say hello, sign in, and as soon as we finish the episode, we'll go into Q&A as always at the end. For everybody else watching this elsewhere, do me a huge favor, smash the like button, subscribe, hit notifications if there's such a thing, so you get notified when things show up, and then put in comments. I do read them, I do respond to all of them. And now let me know what you think about this whole thing. By encouraging more sponsors to use Reg CF to raise capital by increasing the maximum they can raise, they need to increase the pool of projects that non-accredited investors have access to. Rules for Reg CF originally capped the amount the accredited investor could invest in a single deal. Now, this year, it has been cleared and it has eliminated those limits, which now means that they can invest as much as they want to. So before, I don't remember what the cap was exactly, but I want to say it was like 500,000 or something like that. I don't know, I'm making things up. And now they can just put in as much as they want to, which makes it pretty easy. Now, will that mean that they're going to give you all of their money? Probably not. If they're intelligent, they will not do such a thing. They're still going to diversify. Sponsors can now raise capital more easily due to having access to larger pool of investors. At the same time, more investors can gain the right to play an active role in these important markets. So now you can reach out to non-accredited investors. This is huge. The change to how SEC applies and interprets the Jobs Act are far from surprising. The Jobs Act was a major piece of legislation, and in just 8 years old, relatively new, markets, attitudes, and legal interpretations have all experienced significant shifts since the legislation was first passed, and future changes to these laws are seemingly inevitable. So that's one thing. They're also legalizing finder's fee. Way back when, you would get somebody, right, to go and you are the sponsor, and me and I know Jimmy, and I go out there and I find Jimmy and I connect Jimmy to you, right? Technically speaking, people are still paying finder's fees. It just wasn't really legal to do that. Now it is. The recent SEC announcement is to recognize the fact on the ground and to permit finders to both raise capital for a sponsor and receive a commission from doing so. There are two conditions that need to be met. For one, finders and sponsors must have a written contract between them articulating terms of commission to be paid, which is fair, and finders must disclose to investors that they are being paid a commission to basically connect them. So again, I think that that's beyond fair to say, you know what, I am going to, if you decide to join in, I am going to get paid. I think that's very good and very transparent. Crowdfunding goes mainstream. So these changes have helped real estate crowdfunding continue its steady movement. Real estate investing is no longer reserved for the few, rather it is now much more open to the many. And I absolutely agree. I mean, it is opening up quite a bit. But you don't have to invest in real estate only through syndication deals, right? And syndication is basically partnership deals that exist. You can invest in real estate by yourself, right? And a lot of times people invest in syndication because it is truly a passive investment. When you do it through syndication, you basically put in the money. I, as a sponsor, as an overall manager, operator of the whole thing, right? I find a deal, I put it together, I get the financing, we hire the company to manage it. We go out and improve the cash flow. We go out and improve the value. Then we go out and either sell or refinance. Meanwhile, you are just getting paid without doing any of that work. Couple of things to know about syndication is that if you decide to do that, you definitely want to go out with somebody who's experienced. Some of the fees that you can definitely anticipate to get are known as 2 and 20, meaning they will take 2% from all of the funds that are being put together at the forefront as their payment. And then after that, they will collect 20% of any profit. So if the profit is, say, $100,000, they take 20% and then they distribute the rest of it. Which, if they can turn in, uh, you know 10, 12, 13, 20, 30% return on your investment, I think they also reserve to make the money. So that's the only way that they make money on that. Now we're going to switch over to CoinGecko, and we're going to take a look at the market to see what is going on. And OMG, Bitcoin is doing amazingly well. It is pumping. It's up 14.4% over the course of 7 days, up 1.7% over the course of 24 hours, and it's currently holding above $13,143.94. It has been sort of flirting with the whole thing, and it's slowly but surely starting to actually get a hold of that $13,000. And is it going to go up? I don't know. Possibly. Is it going to go down? I don't know. Possibly. Anything is possible. There's not much of a cap on the top end between the 13,000 and the 20,000 that it reached back in 2018, right? That New Year's era of the time, the all-time high. So that's exciting. But is it going to reach it there by New Year's? I don't know, man. Anything is possible. It is 2020, so who knows? But I will show you a lot of incredibly bullish news for Bitcoin and for Ethereum and for crypto as a whole. Speaking of Ethereum, it is holding above 400 strongly. It's at 405.88. It's basically not changed in 24-hour period, up 7.5% over the course of 7 days, and up 0.4% in the last hour. So it's holding steady at about $400. When we kind of scroll down, there's a lot of greenish that we're seeing, some red, some green. When we take a look at what's going on, Filecoin is up. You remember how it was down 27%? Well, it's up 27.8% over the course of 24 hours. Reserve token rights is up 11.7. Elrond up 9.9. Avalanche up 7.8. By the way, I love the fact that they have changed it, and now it's not just the codes, it's actually the names, which helps me a great deal. And then on the losing end of things, Energy Web token down 7%. And then Uniswap down 4.3, and then Waves 3.6 and single digits. So not a lot of users. YFI is down to 13,000. And I do personally think that it is going to continue to go down. I don't know. That's just me. Because I don't think that DeFi is completely gone, as we're going to see in a moment. Over the upcoming articles. But what I do think is happening is that folks are changing. There is no loyalty in DeFi. People were going in with whomever can pay the most. And now we've also seen some scams and some hacks. And we're going to be talking about those things. So you definitely want to stay tuned for those things because they're coming up. So here is the first one, and this is one of those things that I was saying about, You want to play with the big boys, but when things go wrong, you go crying, right? So a hacker stole basically $300,000 worth of Tether because a victim left a wallet keys in an Evernote. Now, if you don't know what an Evernote is, it's basically non-secure. Can we say that again? It's non-secure. Basically, platform for your notes. You're not supposed to put there things that unlock safes, like a digital wallet. Do not put it there. That is stupid, right? So this person stupidly put the keys there. Then they bought Tether, about $300,000, a little bit more than that. Then they transferred into wallet and then realized, oh no, all of the money has been taken away. So then they called Tether and said, oh, somebody stole my money. And then they called the police as well. And then Tether actually locked up their funds. Now, since then, they turned it over to the government, and the government, they have reached out and talked to some sort of hacker who was using Proton Mail, and they used VPN to basically obscure that stuff. So, lesson learned: A, if you're going to play in this industry, stop thinking that somebody's going to save your bacon. If the money is gone, the money is gone. But companies are starting to utilize this stuff, and even with the building of the smart contracts, people are starting to build this in, because as more people go in, more people want to play the high stake poker game, but they also want the protection that they will never lose. Well, you can't have both. I'm sorry. As you can see, I get very irritated about the whole thing. But anyways, they did freeze it. They were helping them out. The police didn't get involved, which I do think it was really, really nice. Speaking of hackers and things that are developing, we also see this guy right over here that we have foreshadowed earlier, 10 minutes ago, whatever it was. And here's what's happening. That we are seeing that the folks are starting to get into the DeFi protocols and starting to hack money out of it. So this one was Harvest Finance. So let's learn what actually happened. So $24 million worth of USDT Tether and USDC stable coin was taken out. And of course, everything plummeted and people started to pull out and everybody started to freak out. So what happened and how? So this is a cool piece. They were working as a yield aggregator, and they were providing liquidity to other DeFi protocols to obtain gains for liquidity providers. Hackers allegedly leveraged this mechanism in Curvewise protocol for their attack. Well, how did they do that? Well, there is an arbitrage that exists because things are traded differently in different exchanges, which gives different prices. And now, because of the advent of the flash loans, you basically can go in, borrow a ton of money, manipulate the value of the whole thing, and then drain it. So that's basically what they did. Arbitrage manipulation using a $50 million flash loan enabled the attackers to stretch the price of stablecoins on Curve's Y pool. The hackers then used the stablecoin and BTC pools on Harvest Finance to obtain a greater amount of stablecoins in exchange for highly priced token on Curve. In less than 7 minutes, the attackers drained 24 million from Harvest's liquidity. Total volume trading on Curve's USDT and USDC shot from about $10 million to over $2.7 billion during the exploit. Nature of the attack has been discussed in detail in the academic paper by researchers from Imperial College in London, and it outlines how to use flash loans to manipulate the price of token pairs and drain liquidity DeFi pool. I have pulled this report. It is rather lengthy. I have not read it, but it is something I plan to read, and I think is right over here. So, nope, that's a different one. That's a different one. Maybe this one? Yes, this is the one. Like I said, I have pulled it out. It's about 14 pages long, and I was planning on reading the whole thing. So, and I do think it will be a very good thing for you to read it as well. A new DeFi hack every day. there's a similarity between the Finance hack with the previous $15 million DeFi hack on Eminence, in that the attackers returned a portion of the lead developers of the portion of the hack money to the lead developer's address. Now, in Eminence, they returned 50%. In Harvest, they sent back 10% of the total hack to the ETH deployer address. Now, anonymous developers of Finance have raised several red flags, and the anonymity of DeFi is adding to developers' advantage who go under untraced and richer. And of course, people are chatting on Twitter and stuff. They were like, oh, so they're not obviously happy about it. And there's additional information from a different article right over here. Right, so they're talking about what happened and blah blah blah. So they did take out 24 million, but then sent approximately 2.5 million back to the deployer, and then they used the money, and then took out money with Ren BTC. So after they basically took the drain the USDT and USDC multiple times, everything was wrapped into Ren BTC and then allegedly siphoned off into Bitcoin, which is an interesting thing. Converting the stolen funds to Bitcoin is an interesting decision. At the same time, it is the only chain that will not have third parties freeze funds on a whim, which we are seeing, right? Tether has done that. We have seen all these smart contracts that you have to create impossible, because it's so new and there's so many things happening that when you discover a bug, when you discover a hack, when you discover that something is happening, you basically want to pause and freeze everything to figure out, like, okay, what is going on, and how do we preserve the money and stuff. So it is very, very different in those regards, that you can't do that with Bitcoin. Ethereum smart contract allowed the coders for effectively to freeze funds and transactions, as well as to destroy the whole darn thing if they ever need or want to. So I think that's something that you need to know about, for sure. Downside to converting to Bitcoin is how everything becomes more public. And of course, now there's going to become a virtual witch hunt, to which the Harvest.finance team is adding to, because they're offering $100,000 bounty to the person who can actually find the hacker, right? And they're saying that all they want on the surface is to see the funds return. However, people are arguing that a large bounty seems indicative of something else is going on entirely, and many people are being very, very wary about what has happened, why, and how. And so, of course, here is the high drama in the world of crypto. I mean, who needs movies and stuff? Like, all you gotta do is just watch what's happening with all the development and developers and the crazy stuff and the high drama, and like that's all you need to watch out for. Now, talking of drama and everything else, I don't want to chat go away. You would think that maybe DeFi is going away. No, no, no. DeFi is back, stronger than ever, and starting to awaken again. The latest DeFi craze is a yield farming and liquidity pool incentivization network called Bond, B-O-N-D. It's a product of BarnBridge, which has just opened the floodgates for the flux of DeFi farmers. Farmers had already contributed over $200 million into the smart contract pre-price discovery, according to the tweet from the firm on October 25th. Then, within an hour of launching on October 26th, over a million more had been accrued in the liquidity pool. Now, what is going on? Well, Bondonomics. Second phase involves the staking earnings from the yield farming program and harvest them onto the new fertile soil. The liquidity pool. I did highlight things over here. Clearly, that did not save. But it contains two sequential staking contracts with distinct specification for public distribution. They want to bridge the gap between traditional finance and DeFi, decentralized finance, building on efficiencies on the latter in order to attract wider range of participants. So what they are basically saying is that, hey, we know that DeFi sector will continue to create market for traditional fi because they're tired of the zero interest yields and with the big old meltdown thing going on. So they're starting to jump in and look for better returns. Second phase involves taking the earnings from the yield farming program and harvest them on the new fertile soil in the liquidity pool incentivization. The incentive aims to reward long term liquidity providers with progressively more power over the protocol. And if you want to read more about it, you can find this on baincrypto.com. I am sure that you can just look for bond and be able to understand it. So there's going to be a 100-week duration with a total of 20% of tokens allocated, and the bond tokens will be distributed as follows: 60% to community, 8% for farming, 12.5 for the core team, 7.5 for investors, 10 into the DAO treasury, and remaining 2% to advisors according to the blog post. And again, definitely should, could, would, and do take a look into what's going on. But now it's time to leave the DeFi forest and go into some of the new cool developments that are happening in this beautiful world of cryptocurrencies. And as you have heard, there's many people that are being very, very bullish on the whole Bitcoin stuff. And one of the bullish reasons is that we've seen MicroStrategy buy into it. We've seen Square go into it. We've seen PayPal get into it. We're starting to see more and more people starting to go into it. And this gentleman, my understanding is that he is David Marcus of Facebook, and he stated that the PayPal decision to embrace Bitcoin and other crypto has inspired banks to follow suit. And so this is the news that is kind of coming in. And of course, we do understand that they are coming. It's just a matter of time. Now he's ahead of Facebook financial, and he's taken to Twitter and basically said, "Exciting to see more mainstream financial service players getting onto the crypto bandwagon. Mainstream banks have started to chase Bitcoin support." It was reported by U.Dots today over the weekend. The recent JP Morgan report stated that in the future, Bitcoin will be able to compete with gold easily. Actually, I personally think that it's going to beat it, but that is just me. JP Morgan analyst Nicolaus Panig, hold on, Panigir, so glue, Panigir Soglu, Paniziglou, something like that. My apologies for Nicolaus. In the long run, cryptocurrencies could turn into something much more than just a store of wealth. And I think it is going to definitely evolve. David Marcus is a former PayPal president, one thing you didn't know, and a Libra co founder. And as you know, PayPal was part of the Libra founding, but then backed out of the project. And there are rumors that PayPal is going to create its own crypto, most likely a stable coin. So we'll see what that all looks like. But interesting part is that right now gold, because they were saying that, hey, could potentially compete with gold. Gold is right now about what, 10 times more than something like that, a little bit more. I'm not, I haven't looked it up in a while, and my memory is not kicking in this morning. So do take a look, and please do let me know if you can figure out. But my understanding is that gold is actually uh, what, 3 times? No, 10 times. 10 times more than Bitcoin. If that is the case, and knowing that we don't actually have more Bitcoin that is coming our way, I mean, there are some that is going to be mined for sure. Then what does that mean? Well, it means that the price absolutely has to go up. And if it goes up 10x to get to the same component, and even if we were to sort of say, well, some is going to be created, maybe it's not, the price is not going to go up 10x, we're still hitting right around $100,000 per Bitcoin. So that's an easy math right now. And that's before, any other craziness that potentially could happen. Now, one of the things that is also interesting is that, there's a recent survey that has gone out that went out to find out what professional European investors, so we're talking European only, this is not worldwide. So when you hear some of the numbers, I need you to think that is just Europe. It is just Europe, and probably, very likely, just Western Europe, part of the EU. I don't know. They didn't specify. They said Europe. So could it be just EU? Could it be all of Europe? I don't know. But it is Europe. So here is basically, oh no, oh no, all of my highlights gone. All right, so we're gonna have to. I had to restart the computer multiple times, y'all. So I'm shocked that things even came up. A survey on professional investor finds that 36% have already bought some crypto, and as big pockets look to enter the market. So what happened? Well, Cointelegraph Consulting has published a 70 plus page research report written by 8 authors called Discovering Institutional Demand for Digital Assets Report. And they're highlighting which coins wealthy investors already own, which ones they plan to buy in the upcoming months. It also looks at the most regulated funds and structured products that are designed for investors from the traditional finance realm. So what they basically did is they took everybody that's gone in, and for total assets under management of the 55 portfolio allocators that participated in the survey was over 719 billion euros. So that's what, 780 billion dollars, something like that. And just keep in mind that it's only 55 portfolio allocators. So this is not everybody. This is just people that participated in the whole thing. Of those that have participated, right? Of those that have participated, 36% have already blockchain inspired assets in their portfolio, either through direct investment in crypto, stablecoins, or security tokens via funds, or some sort of, my gosh, struggle is real. Between allergy and a computer and stuff, just going bananas. But so that's 36% are already in. Of the remaining 64 that are not in yet, 39.29% plan to invest. This results in 61.15% of professional investors in the survey that are either in or about to get in into the near future. Now, of course, when you go to the Cointelegraph, you can actually download the full report. And I think this is, no, that's not the one. This is the one. This is the one right over here. So I have downloaded, and you can see this is brand new. It's October 2020. So it is a very exciting piece to do. So I haven't read it yet, but I plan on reading it. Like I said, a lot of reading for me off camera so that I can keep on scratching my nose and pull it off and throw it away. The majority of investors with exposure to cryptographic assets were primarily interested in Bitcoin and Ethereum, which is 88 and 75% respectively. Now, out of the 39.29 investors that plan to invest in the future, security tokens were more popular than Ethereum, which is very interesting piece to understand. And when we look into the whole thing of what's going on, investors hold cryptographic assets for speculation rather than for use as a medium in exchange. So they're not buying to trade, they're buying to hold, and they hope to front run Wall Street. Here, right here, I think this is the most important thing right over here, which is the part that I have been sharing on this channel. They hope to front run Wall Street by buying in before big pockets enter the market, putting the fear of missing out aside. There are genuine reasons to be excited about institutional investors joining the space. And that is what is going on over here. They want to go in, you jump in before all of this money comes in, because imagine this right over here, $719 billion, Europe only, participating managers only. If only 10% of that jumps in, That's 7.19 billion, right? Now, what is the capitalization of the market I don't know. I don't know. Let's take a look. Coin Gecko, right? Let's see. Market cap of Bitcoin is 243 million. So that's nothing. That's nothing, right? No, sorry, billion. So, this is absolutely nothing in comparison. When you add all of the rest of them up, they probably come to this piece, if that. So the whole thing might be, I don't know, 350 billion. So that means that even the smallest amounts of money coming in are a big, big, big deal. Now, there's additional stuff that is also happening in Europe, and that is that there is a crypto trading or launching EU regulated hedge fund. So here we go. Danish gentlemen are jumping in, and they are launching or have launched the fund ARK36, and I believe this is their website right over here. As you can see, it's a very pretty website, very clean, and you will see they're definitely Danish. They definitely have Danish names, so you will actually be able to learn about it if you want to. But what it's basically they are talking about is here. And they are ARK36 announces its launch as an actively managed investment fund focused on cryptocurrency markets, delivering a risk-adjusted exposure to crypto assets for professional investors. Fund is regulated as an alternative investment fund with limited number of persons by the Cyprus Securities and Exchange Commission, and it is based in Larnaca, Cyprus. If you don't know where the Cyprus is, go out there and get yourself a little map. It's a beautiful, beautiful, beautiful island country that is basically located in the Mediterranean, right basically kind of south-ish of Turkey. So that's general idea where you're going to be looking at. It is beautiful, it is gorgeous, and Cyprus is one of the capitals of the crypto world. So just something to know about. It's beautiful to walk around over there and see like exchanges and stuff, because I don't get to see that over here. We're still kind of weird where I live about the whole thing. Driven interest in the cryptocurrency market, which has risen from a total market capitalization of 17 billion at the start of 2017 to more than 200 billion at the start of 2020. Well, there you go. This is my answer for what I was asking. It's a little bit more than that now. But you can see where the entire market is, and it's absolutely nothing because everything else is in trillions, tens of trillions, even quadrillions. So as you can see, not much going on. So what they're doing is they are among the first fully licensed investment funds in Europe investing exclusively in Bitcoin and other crypto assets, and they make it their aim to deliver risk-adjusted exposure to this new and exciting asset class with a focus on portfolio management, risk management, security, proper regulation, and compliance. So they are a fund. They are regulated as an alternative investment fund, which means that now not only can you buy in Europe, at some point you might be able to buy it over the counter, even here in the United States or around the globe. And are they going to be the only ones? Absolutely not. More and more of these things are coming in. As this starts coming in, ETFs are going to start coming in and start being listed here in United States. We're seeing stuff happening in Brazil. We're seeing stuff happening now in Europe. We're going to start seeing more and more of this start coming in. And folks, I keep telling you, when, not if, when ETFs get big and the entryway into that is easy, and pension funds and endowment funds and fund of funds start going in, right? Bitcoin is going to go up through the roof, as will Ethereum. So if you are even remotely thinking, oh my gosh, I don't know, I am personally saying yes. Now, am I saying, bet the farm on it, borrow against the farm and bet that way? Absolutely not. Hey, absolutely not, man. Don't do any crazy things, right? And again, none of this stuff is financial advice. I'm not a financial advisor. I'm not an attorney. I'm not an accountant. I cannot give you legal advice. Don't listen to the idiot that is speaking right now on the channel, right? But I'm thinking to myself, hey, you know, if the big boys are putting, between 1 and 10% of their funds into this, should I maybe put between 1 and 10% of my money into this as well? And then wait, and then maybe front run like all of the smart European investors are doing, and American too. But the report was for European, and my thinking is, yeah, I should probably do the thing. So I am doing the thing. If you're thinking, should I not? You kick yourself. I was just recently on a call with a student of mine, no names mentioned. We're chatting about a few different things, and it was interesting because we all do the same thing. You probably do this thing as well. I mean, I know I do it. When it's like we look at the price and it's like over 13,000. Oh man, should have bought it back when it was 8. And yeah, should have bought it back when it was 3. Should have bought it back when it was 100. Should have bought it back when it was a penny, Nev. When it was a penny, but I didn't. I didn't. I remember looking at the thing when it was only about 10 cents and I couldn't figure how to buy the damn thing. And I didn't do anything up until we entered the thousands. But I smartened up since then. I smartened up since then because I know it's going to be in tens of thousands and in hundreds of thousands or potentially even more. So I figure, well, I didn't get into the cents. I didn't get into the dollars. I didn't even get into the when it was hundreds. I should get in when it was thousands and ride that wave up because there's still a ridiculous, ridiculous, ridiculous amount of space between here and where it's going. And I firmly believe in that stuff. You don't have to. Nobody's making you to believe or not believe into any of that stuff. I'm just saying what I believe into. You let me know what you think or believe in. We're about to go into the Q&A, so for everybody else watching elsewhere, goodbye. Hit the like, hit the subscribe, hit the notification, and I will see you tomorrow. Until then, stay forever blessed, and do remember, you are only one deal away.